Welcome to the 3-Edge Week in Review for the week of October 27th. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Steve Cucchiaro, Chief Executive Officer and Chief Investment Officer here at 3-Edge Asset Management. And today, Steve and I will discuss the recent pullback in the price of gold over the past couple of weeks. We'll look at some of the factors that led to the decline, provide the rationale for continuing to hold some gold in investor portfolios, and provide an outlook for gold for the remainder of 2025 and beyond. So we have a lot to cover today, so let's get started. So Steve, throughout 2025, the price of gold has really been on a tear, right? At one point, it was up around 60%. That is 60%. And then over the past 2 weeks, come down some from those levels. So perhaps you could describe the recent correction in the price of gold over the past couple of weeks and what we might take away from it, if anything.
Well, you're absolutely right, Fritz, that gold not only went on a tear, but right leading up to the peak price a couple of weeks ago, it just went up so fast within such a compressed time frame.
Yeah.
And in our modeling, we model valuation factors, we model many economic factors, we also model behavioral factors. One of those factors is to try to detect if a particular asset is going up so fast within such a compressed time frame that it's due for some kind of pullback. And we were approaching those levels when the price peaked. And so I would say that the number one reason for correction is because of profit taking, that sometimes people can't believe how much it went up in such a short time. And if they're not in for the long haul, but they were really more momentum investors riding the trend, piling on, try to get more of the upside, then when the correction starts, they think, well, maybe it's time to take profits, or maybe this doesn't have much room to go. And then that is self-fulfilling, and then that feeds more downside. So as sharp as we had a run-up, we did have a sharp sell-off. But just to put things in perspective, over the last 2 years, even after this recent sell-off, gold is still up roughly twice as high. The price is twice as high, double of what it was just 2 years ago. And gold is still ahead of where it started the month. So do want to put things in perspective. Now, there are reasons why we've advocated to invest in gold. There are reasons why gold has run up in the last couple of years, and especially this year. And Fritz, I know that you'd like to share some of those factors. We've had these discussions. I know you have a pretty good list of factors that are, for the most part, still intact.
I do have a list, and it actually is it is pretty long. I mean, there are a number of factors that have contributed to the rise in the price of gold recently, but are also supportive of gold for the remainder of 2025 and beyond. And we've gone through these before. We have the threat of stagflation, where you have an environment where interest rates remain elevated and the economy could slow down, still a threat. We have the weakening of the U.S. dollar. We have threats to Fed independence. And we have, obviously the Trump administration has pushed very hard for the central bank to lower rates. And so there is some concern there. And we also know that President Trump will be able to nominate his own Fed chair in the spring. And people might believe that Fed chair could have a different outlook and maybe have easier monetary policy. We have rising government debt and deficits, and not only in the U.S., but around the world. And I think one thing that, particularly over the last couple of years, has been important is this idea of foreign central banks buying gold, swapping out of U.S. treasuries and taking instead positions in gold because it delinks them from the dollar. And importantly, for those non-aligned nations, it protects them from the potential for the U.S. to potentially freeze their assets at some point. So it's a
great point.
It's a very robust list, and those things are still all intact. So I think maybe if you could take over here and just how should then investors, after the last couple of weeks where we've seen it take a hit, how should investors think about positioning gold in their portfolios now?
Yeah. Well, if I think about past bull markets in gold that lasted many years, we did have some serious corrections along the way. I remember in the bull market from 1972 up to 1980, it was tremendous gain in gold over those 8 years. But along the way, we had some 10, 20, 30, even 40% corrections before it kept going up. So we, in our modeling research, don't believe this is the time to be at your maximum allocation to gold. And as many of you know, a couple of weeks ago or several days ago, we did rebalance our gold portfolios back to target and even lowered the target a bit because we were approaching that overbought condition. So we think in the short term, it's prudent to be quite cautious that these profit-taking downturns can have some life to them. And maybe gold at best goes sideways for a while or even continues to correct. On the other hand, with all the research we've done over the years, we think we would consider it malpractice not to have a certain amount of gold in your portfolio at all times. Gold can react and behave in the opposite way of stocks and bonds given certain catalysts, given certain hits to the economy or the markets. And it can be the only thing that protects you and lets offset some of the losses in more traditional stock and bond investments. So we've done countless analyses and countless simulations over the widest variety of economic and market cycles, covering decades. And we've concluded that at a minimum, one should never have less than 4% gold in their portfolio. That should be the lower bound. And then depending on the strategy and depending on the amount of equities that one would need to hedge against, on the upper bound, it could be anywhere between 14, 15, even up to 20, 21%. And so we don't believe we should be at our maximum right now. We don't believe we need to go all the way to the minimum, but we do believe it's time for some moderation, maybe somewhere between the 2 points.
All right. Excellent. Thank you very much. Very helpful update after the volatility that we've seen in the price of gold over the past 2 weeks. So that will do it for Steve and me for this week. We will be back next week with another edition of the 3 Edge Week in Review. As a reminder, all our videos are always available on our 3 Edge YouTube channel. If you know someone who you think might benefit from the videos, please feel free to share them. And if you enjoy the videos, we would also be most appreciative if you'd be willing to subscribe to the 3 Edge YouTube channel. So, on behalf of Steve and everyone here at 3 Edge, thanks for listening.